Brad, if you want to sell your shares, I'll find you a buyer. That's what Sam Altman told investor Brad Gerstner when he asked a very simple question. How does OpenAI plan to meet 1.4 trillion in spending commitments with just 13 billion in annual revenue? The defensive tone, the Bradish response, it doesn't pass the vibe check, and in my opinion, has partly contributed to some renewed skepticism of the AI technology trade. The market's tone shifted in early November to a more nuanced and, in my view, a more healthy dynamic of assessing the potential winners and losers in this AI arms race. What happens next in AI isn't just a tech story, it's a wealth preservation story. I'm John Cervantes. I manage nuanced investment portfolios for families in San Antonio and Austin, Texas, and this is a practitioner's brief. Let's unpack what actually happened here because it's more important than what the headline actually suggests. On October 31st, Brad Gerstner asked Altman the question any rational investor should ask. Show me the math. 1.4 trillion infrastructure spending, 13 billion in revenue. How does this work? Altman's response wasn't even a simple mental model. It wasn't a path to profitability. It was essentially, if you don't believe me, you can sell your shares. Then the PR debacle gets worse. A few days later, OpenAI CFO Sarah Friar went on stage at a Wall Street Journal event and called for a federal backstop, essentially a government guarantee to finance AI infrastructure. When the moderator clarified, so some federal backstop for chip investment, she responded, exactly. Now, this was quickly walked back by both her and Sam Altman, saying they don't need nor want a federal backstop. White House AI czar David Sachs quickly shot this down, saying there will be no federal bailout for AI. The U.S. has at least 5 major frontier model companies. If one fails, others will take its place. But here's what's odd. A few weeks later, Sachs himself posts about how reversing the AI investment could cause a recession. For me, it was classic too big to fail language. He also later walks this back. The backtracking with this whole group is mind-boggling, and it tells you something important. There may be some concerns about the magnitude and cost of this AI infrastructure build-out. And with midterms approaching and cost of living being a primary factor for voters, no one wants to hear anything about government guarantee for AI infrastructure. So there's a lot of complacency here. It's apparently at the Federal Reserve too. At the Fed press conference on October 29th, Chair Powell was asked directly about AI investment risk by Victoria Guida at Politico. She asked, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what the sudden contraction in tech investment would mean for the overall economy? Powell responded, this is different in the sense that these companies, the companies that are so highly valued, actually have earnings and stuff like that. So you go back to the 90s and the dot-com period, these were ideas rather than companies. So there's a clear bubble there, whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. This is actually a ridiculous statement. Let me be crystal clear. The 2000 technology bubble was very much driven by profitable technology businesses delivering valuable goods and services and the critical technology infrastructure that our economy runs on today. Cisco, Oracle, Microsoft, all very real companies with very real earnings. The Fed chair statement is too dismissive and just factually incorrect. Everyone likes to throw around the pets.com example as the poster child for the 2000s tech bubble. But even at that peak, it was valued at $400 million. Today, there's a whole private market ecosystem that is less transparent and huge relative to the non-profitable tech businesses that were publicly traded in 2000. OpenAI is estimated to be valued at $500 billion and is expected to be profitless through 2029 or so. But here's where my skepticism gets validated by the market itself. Skepticism is healthy. It's a necessary component of market stability. And we can just look at some notable AI-related stocks and some market proxies for risk appetite in the month of November. Circle down 37%, Figma down 28%, CoreWeave down 45%, cryptocurrencies down, NVIDIA down 13%, Microsoft down 5%. Stocks that had parabolic price action, the kind I warned about in October, have fallen significantly. This is healthy price action. It's risk-taking kept in check. And while the OpenAI drama may have sparked some skepticism, Michael Burry, the big short himself, added to this AI skepticism when he had some recent regulatory filings reveal some bearish bets against NVIDIA and Palantir. He followed up with a post stating that hyperscalers are overstating their earnings by extending the useful life of their AI chip investments, essentially spreading out the cost over a longer time period than what's warranted, therefore reducing the cost impact to their income statement. This has received a ton of press, but is this really a novel perspective? Not really. I've seen depreciation arguments used throughout my career to put together various bearish cases. Sometimes they matter, sometimes they don't. But here's what you need to understand. A break in the AI trade will require a change in infrastructure investment from a major hyperscaler, a Google, a Microsoft, a Meta. When one blinks, the others get the cover to follow. And Burry's argument could be the reason for that downshift. We just have to ask, why hasn't the market recognized Michael Burry's argument yet? It could simply be because the music's still playing. Throughout my career, I've received grief for hedging my comments, always saying, well, it depends. And I can feel the it depends spewing out of my prior points. But the reality is, the eventual winners and losers are difficult to pinpoint. Just like the 2000 internet cycle, the new businesses and profit centers that will emerge from this technology are yet to be determined. Just remember earlier this year when Chinese large language model DeepSeek caused a wave of selling across US tech? And today, Alphabet's Gemini 3 leads the large language model leaderboard. Tomorrow it could be someone else. It's impossible to nail, even for the tech bros. And how much time is left in this investment cycle? Also impossible to know. What I do know is this. There will be no alarm bells. No one will ring a bell at the top. No one's going to send you a memo saying, okay, it's time to reduce your exposure. And Cisco's newsroom is a treasure trove of market education. This is straight from the earnings press release in February of 2000. The momentum of the internet revolution continues to accelerate across both business and government sectors on a worldwide basis, said John Chambers, president and CEO of Cisco Systems. A University of Texas study found that in the US alone, the internet economy would account for more than $500 billion in revenues in 1999, an increase of more than 68% over 1998. This continued economic growth, together with Cisco's recognized expertise in the internet, positions us to lead in the internet economy. The market peaked about a month later. So what do you actually do with this information? How do you invest wisely when the narrative now is in question? My whole point is just don't get caught sleeping at the wheel. Diversification is paramount. As I wrote extensively in August, the barbell structure is the best approach to navigate the cycle, and it's about regret minimization. I think of AI exposure as a dial, not a switch. You can turn it up or down based on the weight of evidence. And given what we've discussed today and what I've discussed over the last few months, it's okay to turn the dial down a bit. What a bit means depends entirely on your personal circumstances, your age, your liquidity needs, your tax situation. This is where professional advice isn't just helpful, it's essential. If this video was helpful, please hit the like button and subscribe to the Practitioner's Brief. I publish market insights and portfolio strategy and some financial planning content regularly. And if you're in the San Antonio and surrounding area and need some guidance, my contact details are in the description.